Hello there! I'm sure you're wondering, what the bloody hell is Division 7A loans? Don't worry, I'm here to explain the ATO's confusing explanation of Division 7A loans. Normally, when a company earns a profit, it has a few options for what to do with that money. You can reinvest it in the business, use it to pay down debt, or among other things, reinvest in new technology and equipment. Most of the time, private companies choose to distribute their profits in three different ways: dividends, wages, or director's fees. When shareholders receive dividend payouts or wages, they have to declare it in their individual tax return as income. Now, while this is the most common way of distributing profit, some private companies may look for other ways to distribute their profits without triggering certain tax obligations for their shareholders. For example, they could do this by loaning or advancing the money to them. But in recent years, the ATO has started to clamp down on these types of tax-free distributions or loans. It introduced a new set of rules in the Income Tax Assessment Act that essentially branded these transactions as a form of tax avoidance. These rules are known as Division 7A. The new legislation doesn't necessarily stop companies from lending or advancing money to their shareholders, but it does require them to follow very specific rules to record loan agreements and ensure these transactions are compliant. That's where a Division 7A loan comes in. The Division 7A rules are triggered when a company lends money or transfers property for less than its market value to the shareholder or the shareholder's associate, loans money to a shareholder or shareholder's associate without a formal credit agreement, and the loan is not fully repaid by the financial year's tax return lodgement date, or relieves the shareholder or the associate of debt owed. Unless a Division 7A loan agreement exists, these transactions will form part of the shareholder's assessable income and be subject to income tax at their marginal tax rate. It will be treated as an unfranked dividend to the shareholder, which basically means that you'll be paying an excessive amount of tax on this money. So a Division 7A loan, or Div 7A loan for short, is essentially a way that companies can financially accommodate their shareholders and have it treated as a loan rather than an income distribution. It is important for you to understand that Division 7A loans do not allow you to minimize your tax. It just treats the money you've taken out as a loan for the time being until it's paid back to the company with interest. So, if you have a Division 7A compliant loan agreement in place before effecting the transaction, the rules won't trigger. This means that the loan or advance will be transferred tax-free and won't form an accessible part of the shareholder's income. However, this will be considered a loan, so you will have to eventually pay this money back with interest. Now, you need to know that a company can draw up to two different types of Division 7A loans: an unsecured loan or a secured loan. An unsecured loan is when the shareholder doesn't provide a security for the loan. These have a maximum 7-year term. A secured loan, on the other hand, is where the company has security over the shareholder's property. The security should amount to at least 110% of the loan amount. These loans have a maximum term of 25 years. As long as the shareholder pays the minimum interest required in the loan agreement, which is usually the benchmark interest rate, and repays the full loan balance by the end of the term, they won't breach the Division 7A rules. If there is a breach of the rules, the income will form part of the shareholder's assessable income, and they will be taxed at the marginal tax rate for their loan. The ATO provides companies with a useful Division 7A calculator and division tool. They can use to assess whether the loan is compliant with the necessary rules, including the term of the loan, the benchmark interest rate you may charge, and the minimum yearly repayments throughout the income year. I've left a link in the description box below, so make sure to check that out when you're doing that calculation. You might also want to consider getting professional advice from a legal team and your accountants when it comes to drawing up and entering in a Div 7A loan. If it doesn't meet the necessary requirements proposed by the relevant legislation, it could be considered non-compliant. And if the loan is not compliant, the payment will form part of the shareholder's assessable income. But here are a few things to look out for when checking that your agreement is compliant. First, ensure that the agreement is signed before the company lodges its tax return for the financial year in which it lent or advanced money to the shareholder. Second, ensure that the shareholder is meeting the minimum yearly repayment. Otherwise, the shortfall is considered assessable income. Next, ensure that the company's distributable surplus isn't miscalculated because a company can only lend or advance money that falls within its distributable surplus. And lastly, ensure that the company recognizes that Division 7A also affects trust transactions if there is a trust involved. Division 7A rules can apply to trusts if the trustee allocates money to a private company beneficiary but does not pay, known as unpaid present entitlements. The Division 7A rules would then apply when the unpaid present entitlement is a loan or an advance, when the trustee lends funds to a shareholder of the beneficiary company, or when the trustee forgives or relieves the shareholder of the debt due to the beneficiary company. So that's the basics of Div 7A loans. The most important thing to remember is that while there may be legitimate reasons for lending or advancing a sum of money to shareholders, companies must ensure that they comply with the necessary Div 7A rules to avoid triggering tax obligations for the shareholder. This involves establishing a compliant Div 7A loan agreement that sets out minimum yearly repayment amount, the interest rate, and the loan term. Now, this is quite a complex area of law and accounting, so it's also super important that you go and get professional tax advice. But I hope this video at least helped you wrap your head around Div 7A rules. If you would like to learn more about how the Box team can help you manage your Div 7A compliant loans, feel free to reach out in the comments below. Otherwise, remember to like and subscribe for more business accounting insights. See you guys next time.